Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh from Macro Tides with us to break down what the hell happened with the Bank of England this week. Seriously, Jim.
Yeah.
Tell us what happened.
You said break down, and that basically is what they attempted, and I think succeeded, at least for now, a breakdown in the financial markets. I had written about what was happening with yields in the gilts on Monday of this last week, and noted that yields had gone from 3.3% last Thursday to 4.15 on Monday's close, and by Tuesday they were above 4.5. So you had a severe liquidity issue taking place, and they did what I think central banks are supposed to do: is step in, be the lender of last resort when markets are getting really chaotic. They need to step in, and they did it. So to me, that is the primary focus or goal that central banks, that's what they're there for.
It's a great point. And a lot of people have, over the years, have said, well, hey, Blake, Bitcoin's going to be the new reserve currency and it's going to be the next big thing. And I'm like, without a central banker, and I know a lot of central bankers get a lot of slack, especially Andrew Bailey,
deservedly.
And deservedly, do all of them or any of them or some of them do their jobs proficiently at times of need like this? Not always, but you're right. Central banks can step in, provide liquidity, calm down the markets. What happens if there's no central bank and you got Bitcoin just goes to zero and everybody's on Bitcoin? I don't know. I mean, I'm just using that as an example, but
just
central
as an example, 1893, 1903, 1907, there were panics. And that's why the Federal Reserve was then brought into existence in 1913. For me, the debate is more, have they strayed from what their primary purpose should be? In my opinion, absolutely yes. But like the pandemic crisis in March of 2020, did the Fed do the right thing? Yes, they did. I think the Bank of England did the right thing this week.
All right. Well, I'm glad you brought that up. I mean, and we talked a little bit about it because it's a big deal. I know you don't typically follow the sterling, but it did, break into new all-time lows. It's bounced back quite aggressively, but I guess I should ask you, I know just because you're following the subject matter, do you think it's over for the sterling? Is everything going to be better from here, or is it a wait and see?
No, it's a wait and see.
Okay.
I think you get something close to a retest is all, in my opinion, likely. You still have the fundamental problem of a lot more borrowing and so forth, inflation problems, a recession next year. Those things didn't go away. So I believe the pound is probably more at risk than gilt yields. And the reason I was following the gilt yields, because in my opinion, what was happening with them was pulling long-term rates up across the board. So on Monday, I noted, hey, the gilt yields had gone up 120 basis points, and treasury yields since last Thursday, a week ago, were up about 25 basis points. So in my mind, what was happening is we were seeing the spillover effect globally, again, which is another reason why the Bank of England doing what it did, I think, was the right move.
All right. Well, let's jump into some of your topics because we've got a few of them to jump into, and one of the first things that you brought to us, Jim, was the LEI, or leading economic indicators. And what is this chart in particular telling you?
Okay, so basically, I like the leading economic indicator as a preferred measure of identifying when and likely a recession is likely. So everybody looks at the yield curve. Well, the average lead time is like 19 months. On the LEI, it's about 10 months. But if you use this 6-month rate of change, it shortens it to less than 7 months. So the LEI, the absolute number, and this chart is not that, it's the 6-month rate of change, has been down for 6 months in a row. And as you can see in the far right, it's at minus 0.8. So as you know, we've talked for several months now about this. I have felt that a recession in this year was unlikely. It was more likely if it was going to happen next year. and I really believe we are going to have a recession next year. So if we take 6-7 month lead time from August, to me, what this is suggesting is a recession is likely before the middle of next year.
Wow.
So
All right. Well,
not this year, but next year.
But okay, so markets like the equity markets are a pricing indicator, or they tend to price things maybe 6 months in advance. So, and that's like kind of a good rule of thumb that I've always followed.
Right.
So maybe equities might start showing some weakness. I know you're going to bring up your charts here in a moment, but that's something I'm thinking of.
Yeah, no, I think again, the shoe to drop here is the Fed in its projections last week. The GDP would drop to 0.2% this year and then increase to 1.2 next year. So they're still pitching the idea of a soft landing. I think Wall Street wants to believe that. If you look at the credit spreads between treasuries and junk bonds, it's unbelievably narrow. The only way that's justified is if you don't think a recession is coming. So I think the next shoe to drop sometime in the next handful of months will be, oh my goodness, we are really going to have a recession. Earnings get marked down. Now, what I wanted to point out here is there's going to be some pretty good news over the next 6 to 7 months on inflation. So the CPI and PC, all these indicators are 12-month rates of change. So you always want to look at what number was getting taken off. So what this table is basically is if the CPI goes up by 1/10, 2/10, or 3/10 every single month, the next 6-7 months, what will happen to the CPI headline number? Well, if it only goes up 0.1%, the CPI, when it's reported in mid-April for March, would be at 3.71%. If we get a 0.3% increase every single month, it'll be 5.1%. So you're going to see a significant drop. What's likely, Blake, is in the near term, 0.2 to 0.3 may be what we get. And then as we get into next year and things slow down, in the shelter component of the CPI starts to, the rate of increase slows, you're going to be more like 0.1. So my point has been, is by the time we get to next April, the CPI headline number in all likelihood is going to be below 5%.
So you feel like you feel like some disinflationary pressures are really coming to the market.
Absolutely.
Then. Okay.
Absolutely.
Good. Okay.
So, but the main point again I will make is the Fed will be happy to see all this, but labor market tightness, and we talked about this I think a couple of weeks ago, is the next thing that they're focused on. And that's going to take a while to happen. So just because inflation comes down, the Fed's not going to pivot. But yes,
I was going to say, so next week, you're telling me I should not be betting against the non-farm payroll numbers.
Yeah, I don't think they're going to be super weak. Think about this. As an employer, there's 2 job openings for every unemployed person. So that hasn't really come down yet. So the first thing that we're going to see is that number come down. And then we'll see hours worked come down. And because employers have had such a difficult time getting employees, are they going to be quick to let people go? I don't think so. So the labor market is likely to be pretty slow as we go through that transition. And that's, again, why I think the Fed, and this is what they've said, they're going to bring the Fed funds rate up to a level and then hold it there. And what they said last week was, yeah, the Fed funds will be at 4.4 by the end of this year, 4.6 by March, and then we're going to hold it there pretty much all next year. My point is that, yes, we're going to see relief on inflation. The Fed isn't going to pivot to cut rates. What they're going to do, in my opinion, is they're not getting to 4.6 on the funds rate. I still think 4.25. I've been saying 3.75 to 4.25. With the projections last week, I think potentially the funds rate peaks at 4.25. So I think there's a good shot at the November 2nd meeting, Blake. They're not going to go 75 again. They're going 50.
All right. Sounds good. The market will cheer that. I mean, they will.
They will.
Yeah, they will.
It will. But again, that's the thing. They have to understand fully the Fed is going to hold rates higher for longer. Yeah, which means we're going to get a pronounced slowdown in the economy. Whether I think it's going to ultimately wind up in a recession, but that's the other shoe. So we've been talking about TLT since the high in March of 2020 at 179.70. To me, this is one pattern that the which indicates that TLT is likely potentially near the low of that whole move down with rates going up. Worst case, it's wave 4, and we're going to get a decent bounce. So what I've been saying is buying TLT on weakness makes sense, because I think there's a shot that we'll see a rally up to the 118, 120 level. And if this pattern is right, you're talking more like 130. So we're at one of those junctures. And again, what's going to happen? We're going to get more and more data showing weakness, and we're going to get some relief on the CPI. That's going to be supportive. It's going to take a while. All right. This shows, since the August 22nd high, that's where number 4 is. That's wave 4 of 5, within 5 of 5 down from 172. So we're really bringing it down to the micro level. I think there's a chance that TLT could go one more time to a new low. So in other words, from that number 4, you got 1 down, 2 up. The low early this week, where I have the number 5, that could be 3 of 5. ABC up, that finished this morning for 4 of 5. You go down one more time, and then I think the rally kicks in. So those are I recommended a 33% position on September 22nd. TLT opened at 105.69, and on my WTR this past week, the 26th, opening on the 27th, 102.71. So I've been trying to layer in as this bottoming process unfolds.
All right, sounds interesting. I know all of us would really enjoy it if yields came down a little bit, and we saw a little bit looser financial conditions in the markets. How do you translate that into the S&P? Because on your S&P chart, I mean, look, we're testing new 52-week lows today, or not today, but this week.
Yeah, so yesterday. Basically, we made it yesterday.
Yeah. So what do you make of this?
I think you can get a bounce above that 37 is kind of like an ABC. Towards there, and then I think you get another leg lower. Again, at some point in time, what typically happens is the bond yields and equities diverge, where bond yields start coming down because, hey, we really are going to have a recession. And
people are flight to safety, right? Flight to
safety. Yeah. Obviously, in the current environment, that rings true. But even without that, you get the last drop when people say, oh my goodness, earnings got to get marked down by 10%. They're still looking for earnings to be up next year. Blake, excuse me. So I just think that's the last shoe to drop, is you get the earnings marked down, multiples get marked down. And as I've noted, often, the 50% retracement of the rally from the low in March of 2020, the 2,200 to 4,800 this past January, is 3505. So I just think that the odds are we're going to get there one way or the other.
Okay, and well, let's try to be optimistic, and let's just hope we get there later rather than sooner. How about that? And let's just go there.
Yeah. The slower it takes, that probably is more constructive in terms of the overall functioning of the markets. Okay, dollar.
You were bearish the dollar last week. You said that we were going to reverse here, and we have. So that's interesting.
Yeah. Well, again, I obviously had no idea the Bank of England was going to do what it was going to do.
What? You didn't?
I did not know. It's amazing. They didn't call.
They didn't call you?
They didn't even leave a message. So again, you hit a trend line. You can see the prior highs going back the last 5 months or so. And I think you need to get below 111.80 on a close. And I'm still waiting for the red 5-day moving average to cross below the green moving average as confirmation. So I think we're going to see I think the dollar is going to pull back more. But then I think the pound has the potential of being I think it's about 13% of the dollar index. I think the pound is going to retest those lows or get darn near them.
Well, I mean, if it does, the dollar is going to have a very difficult time moving higher substantially without the sterling. Is that correct?
Yeah. So I think in the near term, I think, again, I think the dollar is going to pull back to 105. It's definitely been stronger. But you know what? I've mentioned this numerous times. Sometimes dollar strength isn't dollar strength. It's really more weakness in other currencies. We saw it with the euro, and now we've seen it with, and of course the yen, and then this last week or two has been with the pound.
Right.
So I think you have to keep that in mind. So to the extent that more stability shows up in Great Britain, that'll be a plus. All right, gold. I still think there's a shot here that we'll get above 1,700 on a move. We're not talking about, but it needs to get back above 1,700 and stay above 1,680 to have any hope of getting up towards 1,800.
We need some daily closes above here, right?
Absolutely, absolutely. Okay. But the sentiment is, I think, less than 10% bulls. Again, you look in the positioning, Blake, of large speculators. They're barely long. The commercials are hardly short. That usually is pretty constructive. So again, if we get to the place where treasury yields start to come down, the dollar backs off a little bit, I think gold is going to pop.
All right. Well, I've been looking for that and really hoping that was going to happen. And gold has it's really struggled on that move up to that 1680, 1690. And I've been telling our traders, close back above 1700 really is needed. And I think you're seeing it the same way. Creates a little bit of a false breakdown, but look, we're at the end of the month, and unless something dramatically changes between now and the next few hours, it looks like we are going to close below 1700.
Yeah.
So that's
no, I mean, again,
right?
You're 100% right. And from asset allocation, I think we're seeing some money coming out of treasuries and going into stocks a little bit today because of the decline that we've seen. So this last day of the month, I think, is ripe for head fakes and false information. But again, the gold needs the dollar to stop doing what it's been doing. And if you look at the degree of strength in the dollar, gold has held up. If somebody had told me the dollar's going to 114 and change, where do you think gold is going to be? I would have guessed a lower number than
1,300. Yeah, right.
Yeah, 1,350 or, I mean, it just definitely would have been lower. So yeah, it's been dragging its heels. But again, I think there's a chance, as you pointed out, above 1,700, that drop below 1,680 could be a head fake where there had to be a ton of stops underneath 1,680 for obvious reasons. They've cleaned them out. And I think that sets the stage for at least a bounce and potentially up towards 1,800.
Awesome. So, well, Jim, I love having you here on Fridays. It's great that you get to keep us up to breast what's happening in the markets, all across the markets. But how do you do that with your traders that you deal with on a weekly basis? How do we find that out?
Well, they subscribe to Macro Tides at macrotides.com, and I'll send subscribers every Monday the weekly technical review, special updates when required, and then the monthly Macro Tides, which takes a bigger picture and puts some of the bigger pieces into, I think, perspective.
Well, Jim, thank you so much every Friday spending your time with us. If you like what Jim does, make sure you give him a thumbs up, subscribe down to the channel below so you don't miss any of this exclusive content that we have here with Jim Welsh, the man. So Jim, have a great weekend, and we'll talk to you next week.
Thanks, Blake. You have a wonderful weekend.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.